Hello everyone, it's Friday and you're watching Within the Frame where we delve deeper into the top stories not only in South Korea but across the globe. I'm Kim Bo-kyung. South Korea's central bank on Thursday kept the key interest rate unchanged, among worries that such aggressive monetary tightening could hurt the country's growth. However, its governor noted that such a rate freeze steady at 3.5% is not going to be the end of the monetary tightening cycle as inflation still continues to stay above BOK's target level. How is such a rate freeze going to affect the South Korean economy? And what further decisions would BOK make, considering many other variables such as the Fed's decision to come in March? For an in-depth analysis of Bank of Korea's recent decision, its impact, and the forecast, we invited Choi Sang-yup, Associate Professor of Economics from Yonsei University, on the line. Professor Choi, welcome to the show.
Good evening.
Good evening. And we also have Trin Nguyen, Senior Economist from Natixis, joining us live from Hong Kong as well. Trin, welcome and thank you for your time.
Thank you for having me.
All right, first question to you, Professor Chen. The Bank of Korea on Thursday froze its base interest rate for the first time in a year and a half. Now, what was behind this decision?
Well, to give you guys some background, the monetary decisions made by central banks, including Bank of Korea, are based on various macroeconomic developments, such as inflation, output, unemployment, which is so-called Taylor rule. So at face value, the recent decision by the BOK may indicate a greater concern for the slowdown of the economy rather than inflationary pressures. However, Governor Chang Yong-ri has also noted that heightened uncertainty surrounding the future course of the economy. So economic theory often suggests that it's best to wait and see before making preemptive decisions in time of uncertainty. Currently, there are mixed news and numbers regarding not only the Korean economy, but also the global economy. And reflecting this development, the U.S. stock market has not shown any strong direction in the past few weeks. Therefore, we shouldn't interpret this latest decision as a sign of monetary easing, and we shouldn't rule out the possibility that the Bank of Korea may increase its policy rate in the next meeting or so. So to me, it's quite crucial to carefully track the headline inflation to learn about the future course of the BOK monetary policy.
Right. So the focus is that it's not a sign of the monetary easing. Now, Dr. Nguyen, although we don't know what decision the BOK is going to make during its next monetary policy meeting, the International Monetary Fund recommended that Asia's central banks raise interest rates further and to stay alert. Why is this so?
Well, first, we have to put Korea's 300 basis point rate hike in perspective. It's the steepest in Asia, and it is the first. The second reason why I think while the IMF recommends its further rate hikes, we have to be mindful of the balance between growth and inflation. By being so aggressive, the central bank is hoping that it will suppress demand and thus core inflation will fall. Now, we have very strong indication that economy is already feeling that, right? Retail sales are slowing, exports are in contraction, and it's likely to be the case in the first half because Korea's key exports, chips, are facing a downward cycle that's not expected to recover. The second aspect is obviously the housing market and the impact of higher rates on households. We know that a large share of household loans, about more than 75%, are variable, which means the pass-through of higher rates have been quite substantial. The third aspect is what that means for the corporate sector. Higher interest rates have actually created stress in already, as you know, the corporate bond market. An indication of the government not willing to take it further is that they have done quite a lot to support narrowing the spread between what corporates have to pay to borrow and the central bank rates. By doing that, they introduced a package. They also expanded collaterals by the central bank, which essentially is an easing of not the price of money, but the expanded collateral means on a quantitative side. So what that tells me is that they need to be mindful of the fact that they have done quite a lot, and they have to wait for the lag impact of monetary to transmit into the economy. And so far, it shows significant weakness. We believe that GDP will slow to below 1% this year, which is lower than what the central bank has at its target for GDP. And because of that, in order to engineer a soft landing, I don't think there is any more room for the BOK to hike. They did strike a much more hawkish tone by saying that potentially we can go for another 25 basis points. But frankly, we're at the end of the cycle. The question is, what happens next? Will we have a cut? I don't think so anytime soon. So we may have a pause, but it's not a cut coming soon. As the professor mentioned, I don't think we're at the beginning of the easing cycle, but the tightening is clearly towards the end. Whether or not we have no more hike or a 25 basis hike, I don't think it's going to be quite significant.
Right, so we'll have to wait and see. Now, there are many things for the Bank of Korea to consider when deciding the further whether they're going to do the rate hike or do the pivot. But I'd like to tap on some of the specifics now. The Consumer Price Index, a major barometer of inflation, is still in the 5% range right now. Though the BOK says the situation will improve in time, there are still many variables that could affect inflation, such as public utility prices rise. Now, what is your takeaway on this, Professor Choi?
I agree that the situation will eventually improve and inflation will come back to the BOK's 2% target. But the main issue is how much longer we should endure this higher inflation. So as you mentioned, public utility prices have surged, which is a significant part of the consumption basket. So rising utility prices have a direct impact on inflation. Moreover, they often serve as input of production, so indicating that there is still room for a rising cost of production, which can lead to a higher producer price index and eventually feed back into consumer price inflation. I'm particularly concerned about the impact of rising utility prices on households with different income levels, because low-income households have different consumption basket. Rising utility prices are especially damaging to them and threaten the livelihoods of the vulnerable. And it also increases inequality between rich and poor. So this issue is very challenging to tackle using monetary policy alone and requires some fiscal intervention. However, rising public debt and fiscal deficit are limiting the scope of such intervention these days. So therefore, to me, it's crucial that policymakers take into account the impact of rising utility prices on different income groups and prioritize measures to mitigate the adverse effect on vulnerable households. So we need to strike a balance between containing inflation on one hand and ensuring that vulnerable households are not disproportionately affected on the other hand.
Right, I see. So the government needs to focus on supporting the vulnerable group in terms of the further inflation that could come. Now, Dr. Nguyen, another variable to consider is what the U.S. Fed's decision is going to be in March. Now, let's first look at the U.S. domestic economy right now. Experts are pointing to a potential no-landing scenario and are saying that the Fed might be thinking of more rate hikes. But first of all, what is this no-landing scenario and what is your point of view?
So the landing essentially is that when you raise interest rates, eventually that would transmit to the economy, which means it suppresses demand enough that inflation will slow. And when you have unemployment rates going worse and inflation getting better, then you have what we call a landing, which is a soft or hard landing. A hard landing is basically a contraction, an BER, contraction definition, and then more than a 1% drop. Now, it doesn't matter if we have a soft or hard landing. The reason why markets are obsessed with having to land is that when it lands, it means that the easing cycle, the tightening cycle is over, and that we can look forward to the easing of financial conditions. Moreover, at this stage of the cycle, corporates would have fired people, would have reduced capex, and they have a leaner balance sheet, and they're able to be on the expansion side. So usually it's quite looked forward by markets. Now, the reason why markets have reprice what happened in January and February quite violently, either in the bond market or the equity market, is the fact that it was a bit too optimistic. Let's not forget the Fed was raising aggressively in 2022. Now, we're only at the beginning of 2023. When we study the past 11 cycles since 1965, we can see that it takes about several years, right? In the financial crisis period from May 2004 to 2006, it took until 2009 for a contraction of the economy to happen. So what that means is that we're in no man's land. We're in no landing scenario in that we will land. It's a question of when, and when is not coming soon enough for markets, meaning we're going to reach the end of the terminal rate, which is likely to be between 5.25 or 5.5, but we're not going to get the cut, right? Because we're not going to get the worsening of unemployment, which is at 3.4% in the US, which is decades low. And we're not going to have the slow of inflation that's going to slow towards 2% enough for the Fed to do this comfortable cut. So to preserve its credibility, the Fed will hold it at a higher level, and that's going to be quite uncomfortable for interest rate sensitive sectors like real estate, leverage sectors, and so on and so forth. And it's very uncomfortable for economies and companies in the rest of the world that have to compete with this. If you are not in the position to raise interest rates like South Korea, where you have a significant deceleration of external demand, you have rather a lot of leverage, and the leverage is variable, particularly the households, then what that means is that you're trying to shelter your economy from a significantly hard landing. But you're going to see that in the Korean won, right? Because when you have differentials, it means that there's less appetite for portfolio investment in Korea, and potentially you can have Korean households more interested putting in dollar deposits and so on and so forth. So that pressure is being felt in the Korean won, and we can see that already with the depreciation. And the question then is inflation going to accelerate once you have that feed through a weaker Korean won into inflation? That is very uncomfortable. The lucky news for us is at the very least, inflation, even if it's falling very slowly, is falling in South Korea. And that means that for the Bank of Korea, it's not going to be comfortable to hold, but at least it will hold, but it is not going to cut. And that's a key point we want to make here, is that across Asia, Korea is the most aggressive in hiking, but it's running out of space to do so. And very similar to the rest of Asia, even if the economy needs help, inflation remains sticky. And other than that, given the fact that the differentials in interest rate will put pressure on local currencies, they don't really have a lot of room to cut. So there is no pivot expected in the short term. And so therefore, the no landing scenario is actually leading to a no landing scenario in Korea as well.
Right, so no cut. Now, Professor Choi, if the Fed does go ahead with yet another rate hike, then the rate gap between South Korea and the United States would be much more widened with the BOK's recent freeze. Now, how does this rate gap affect the South Korean economy? And would Fed's rate hike make BOK lean towards rate hike as well?
Well, the widened rate gap between Korea and the U.S. will definitely put the Bank of Korea in a more challenging position to engineer its monetary policy. However, we can make some comfort in the fact that the FX market has not really shown significant vulnerability in recent times, especially compared to a few months ago, like last year, October or September. So this is somewhat alleviating the pressure on the call for more hawkish monetary policy by the BOK. However, we can be overly optimistic about the FX market, as market participants in the FX market tend to be very much forward-looking, meaning that they are not only factoring in interest rate gap or inflation differential between the two countries, but also the future expected path of these gaps. So as long as investors start to realize that the inflation gap between the two countries remains widened, so that interest rate gap between the two countries also remains widen or continue to increase, there could be a sharp reversal in foreign capital flows, leading to sharp depreciation of Korean won, as we've seen in the last year. To me, so it's essential for the Bank of Korea to closely monitor developments in the FX market and take appropriate action as necessary to prevent those excessive volatility.
Right. So, Professor Choi, since you tapped on the depreciation of the Korean won, on the foreign exchange front, the Korean won continued to lose ground against the U.S. dollar, with the $1 exchange rate closing at 1,304.9 won for dollar on Wednesday. Now, is such signs of fluctuation going to continue, and how will a weakened Korean won affect the South Korean economy?
Well, it's extremely difficult to predict whether the Korean won will continue to depreciate against the dollar or not, especially given the uncertainty surrounding the future path of the interest rate gap. But let's assume that Korean currency does continue to weaken. In such a scenario, we can consider two different channels to understand macroeconomic consequence of weaker won. So first is the trade channel, and the second is the financial channel. So according to the trade channel, a weaker currency can stimulate exports and discourage imports, thereby boosting aggregate demand and output. So this is very standard theory, and it demonstrates a positive side of domestic currency depreciation. However, we also have to consider some counteracting forces through so-called the financial channel. So depreciation of Korean won can increase that burden of Korean banks or firms that have taken dollar-denominated debt. So this adverse effect coming from the financial channel will be even greater if there is a currency mismatch in their balance sheet. In other words, when they borrow in foreign currency but lend in domestic currency for banks, or borrow in foreign currency but sell products only in the domestic market and making profit in domestic currency won. So, answering to the relative strengths between these two channels is a very difficult question requiring careful analysis. But we can gain some sense of the strengths of the trade channel by looking at the relative value of Korean won with respect to other currencies, not dollar, but competing in the global market. But, despite this weakened Korean won since the last year, exports are not really doing well, suggesting that the negative effect of the financial channel can actually dominate the positive effect of the trade channel.
Right, I see. Now, Dr. Nguyen, then the BOK governor said himself that the first half of this year will be quite difficult because of low exports and a global economic slowdown. Now, what is your takeaway on this, and how do you believe South Korea should tackle such a slump?
Well, I think I completely agree with the governor. I think it's going to be a very difficult first half because as higher interest rates transmit to the U.S., the EU, you're going to have weakened demand, particularly if there's a recalibration of demand for things that Korea tends to export, which is semiconductor that has an investment glut, which means it actually has to go through this cycle, and it's a very cyclical sector in general, which means that at some point it is expected to recover, so the second half will get better. The second aspect why it is a difficult first half with South Korea, it really has to do with the rise of interest rates in the U.S. that puts a lot of pressure on Korean asset price. And the second aspect is that what that means for the Bank of Korea itself, is it going to be able to comfortably hold interest rates in the first half? Is it going to hike a bit more? And if it does hike a bit more, it's going to be still very uncomfortable to monitor the impact. So in general, I think the first half is very difficult. And the second reason why it's difficult is that this China normalization story, although was aggressively priced in January, when you look at the technical aspect of China recovery, you can see that it's unlikely to reach the acceleration part until the second half, whether it's international tourism or Chinese increase of consumption, which would help offset some of the decline to other markets such as the US and the EU. So in general, very difficult period. And this is one of the reasons why I think for the DBOK, it's emphasizing the economic aspect of its economy because buying space to hold, right? Of course, it wants to be concerned about inflation because that is its mandate about price stability, but it also is carefully concerned about this deceleration of growth, particularly because fiscal policy doesn't have a room to offset it. In general, as a result of this, I think and I continue to think that they are at the end of their hike cycle, and maybe they will surprise with 25 basis points more, but fundamentally there is no more room to hike.
Right. Now, although I'd like to hear our experts' advice more, I'm afraid we only have a few minutes left. And so my last question would be to Professor Choi. Because of the rapid rise in interest rates for more than a year, as well as a sluggish real estate market, Korea's total household debt declined for the first time in about a decade. Is this downward trend going to continue for now? And to what extent should it go down to be safely managed? Could you briefly explain it to us?
Sure. So the rising household debt has been a major concern for the Korean economy for past years. However, it's quite ironic that a slowdown in household debt could also be a problem this time around. Remember that household debt is also determined by the supply and demand for consumer loans and mortgage loans. So there's a very interesting survey data from the Bank of Korea that I've been using for my own academic research, which helps us understand whether the recent decline in household debt is driven by supply or demand factors. So basically, the data suggests that bank lending standards for household loans are extremely relaxed these days, meaning that banks are, eager to lend out, but households are simply not taking out these loans because they have a very pessimistic view about the future course of the economy and high borrowing costs. Indeed, household loan demand is at almost a historic low these days. So as long as hawkish monetary policy continues, meaning that further rate hike is not highly likely, but at least the BOK maintains the level of the policy interest rate as is, I believe the household debt will continue its downward trend.
Right, I see. All right, unfortunately, but this is all the time we have for today's edition. But thank you, Professor Choi and Dr. Nguyen, for your insights and for helping us to better understand this difficult economic sector. We appreciate it.
Thank you.
Thank you for having us.
All right, that's all for Within the Frame tonight. We will be back next Monday with more in-depth stories. Thank you for watching and goodbye.